Let's start with all the market action. Stock markets across the world inched higher as the US and China agreed on a framework to resume the trade truce. President Donald Trump has said that the deal with China is done and the relationship between the two countries is excellent. Here is how stocks closed across Asia. The Nifty ended flat but maintained its winning streak for the sixth day. Stocks in China, Hong Kong and Japan ended in the green. Meanwhile, the South Korean Kospi posted healthy gains, closing at its highest level since January 2022. Shares on Wall Street received a boost after the US reported a better than expected consumer inflation data for May despite President Trump's tariff actions. The consumer price index accelerated 0.1% in May against the expectation of 0.2%. Meanwhile, the annual rate stood at 2.4% in line with estimates. President Trump's deadline to lift the pause on reciprocal tariffs is less than a month away. But what kind of impact will the US economy need to brace for? Joining us right now to discuss this is Eswar Prasad, professor at the Dyson School at Cornell University and senior fellow, Brookings Institution. Eswar Prasad has written books on the US dollar and the Chinese currency and served as the head of IMF's China division. He has also written a piece in the Foreign Affairs magazine about how President Trump was launching a turbulent new era for the global economy with his tariffs. Mr. Prasad, thank you very much for joining us here on Global Lens. Let me begin by asking you about your reading of the CPI data. With inflation coming in softer than expected, is there now hope for a rate cut?
This actually puts the Federal Reserve in a very difficult position because there is certainly a little more room for maneuver because actually the CPI headline number ticked up a tiny bit from the last month, but as you pointed out, came in roughly in line with expectations. The difficulty this is going to cause for the Fed is that it will mean a great deal more political pressure from the White House, with President Trump already calling for the Fed to undertake significant rate cuts, while the Fed is bracing for the potential impact of tariffs on prices, because it is highly likely that the tariffs that are already in place and some of which might come back on if there are no trade deals struck by the US, those could add to price pressures later in the year. So the Fed is trying to hold its fire, but it looks like there is going to be a lot of political pressure it'll have to deal with.
Right. Do you expect the tariffs and the uncertainty around tariffs to start impacting inflation negatively in the months ahead?
It is possible and indeed likely that the tariffs and all the uncertainty they have created will dent both household consumption and private business investment. So you could start seeing the economy beginning to cool off, which could certainly ease the price pressures. But the remarkable thing about the US economy, at least so far, is that none of this really shows up in the data. If we were thinking about where we were at the beginning of this year, when it looked like a soft landing with a gradual reduction in growth and a decline in the inflation rate towards the Fed's target of 2% might seem feasible, we seem to be sort of on track for that. So everybody is bracing for things to go wrong. But so far, the labor market has held up quite well. Inflation still seems to be on a slight glide path down, and the economy overall is doing so well. So we are bracing for bad things to happen, but they haven't happened yet.
Right. I'd also like to ask you about the good news coming in with the US and China announcing in London that they have agreed on a framework. Donald Trump has said the deal is done. US gets 55% tariffs, China gets 10%. How do you see this? This will definitely be a relief for US investors, especially the tech industry. But do you think this will have a positive impact on the economy in the months ahead?
Now, this is a very positive development that at least the two sides are talking with each other at both the leadership levels and also at the policy levels. And many of the pain points that these two economies had inflicted in each other have looked like they're going to be resolved. So China really wants chips from the US computer semiconductor chips, that is, and the US wants access to rare earth minerals, which China has restricted exports of. So those pain points are going to be resolved. But it's worth noting that what we've heard so far is really about a framework towards negotiations rather than any substantive deal. All we have so far in terms of details is the social media post by Trump. We have not seen any of the details of a broader agreement. My suspicion is that it's going to be a much more arduous road ahead before the two sides can significantly de-escalate tensions, but it's certainly a good sign that the relationship between the two sides, which had been deteriorating, now seems to be on a somewhat positive trajectory. This should help both their economies and also financial markets in these two countries and also the world more broadly.
Right. When it comes to Donald Trump's new tax bill, he's pushing this very aggressively. What kind of an impact is this going to have on U.S. deficit?
That is a very worrying prospect because, as it is, the US has been running very high deficits. And in fact, the gross federal debt to GDP ratio is now about 1.2 times annual GDP. That's 120% of annual GDP. And given the size of the US economy, that is a very large amount of debt. Now, one of the things that's kept this debt from leading to very significant interest rate hikes is the fact that US Treasury securities are still seen as the world's safest financial assets, and investors around the world look to this asset for safety during times of financial turmoil. But things seem to be changing in the Treasury securities market. Most recently, when Moody's, which is the third rating agency to downgrade US long-term credit rating, downgraded that rating, that really had a slightly negative impact on US long-term rates, which has not been the case in the past. The US dollar also has weakened quite a bit this year. So it seems like something fundamental is shifting. And the other concern is that in addition to the huge amount of increase in debt issuance that would result from the tax bill being passed, from the fiscal bill being passed, which would lead to significant tax cuts, there have been very significant liquidity problems in the Treasury securities market. This is seen as the most liquid market, which means that it's very easy to buy or sell large quantities of Treasury securities. But a variety of regulatory and other market changes have really affected liquidity in this market. So this is a market that is really looking very fragile right now because of the huge increase in supply of US Treasury securities likely to come onto the market, while the demand seems to be somewhat easing. And given that this is the benchmark asset for US financial markets, and indeed for global financial markets, if there are any problems in the US Treasury securities market, it's going to affect all of us.
Right. I'd also like to ask you about the move away from dollar. And we're seeing this in Asian markets, growing focus on how to use local currencies for trading to avoid the risks related to currency fluctuations. Do you think Donald Trump's tariffs will further increase the pace of de-dollarization?
There are other changes actually that are going to be far more important than the tariffs. The US has been using dollar dominance as a weapon against its geopolitical rivals through financial sanctions. And in some of my writings, I've argued that the size of the US economy, the depth and liquidity of its financial markets are very important for the dominance of the dollar. But equally important are the key elements of the institutional framework, which includes the rule of law, a system of checks and balances between the government and between various arms of the government, and also an independent central bank. And Trump has essentially taken the hatchet to every element of the institutional framework. So we should be seeing a reduction in the dollar's use. And there are technological developments that also should be leading to a diversification away from the dollar as a payment currency. We are seeing China, India, many other emerging market economies set up their own payment systems that can more directly communicate with the payment systems of other countries. So you don't need a vehicle currency like the dollar or the euro in order to intermediate transactions between these currencies. But the curious thing that has happened is that a lot of these changes have taken a bigger toll on some of the other reserve currencies, such as the euro, the Japanese yen, and so on. So yes, the dollar share as a reserve currency has slightly shrunk in the last few years, but there's been a great deal of fragmentation in the second tier, which includes the euro, the yen, the pound sterling, but also the Chinese renminbi, the Indian rupee, and some other emerging market currencies. So we have this curious phenomenon where the dollar is a little less dominant in absolute terms, but in relative terms, it still retains its dominance. This is not a story of American exceptionalism, in my view, but about economic and financial weaknesses in the rest of the world. But certainly, some diversification away from the dollar both as a reserve currency and a payment currency, is in the offing, and we seem to be seeing the beginnings of that. But I'm not expecting, full-blown knocking of the dollar off its dominant pedestal as of yet.
Right. Since the start of this year, and you've also mentioned about the weakening of the dollar index has weakened 8%. What would you expect possibly in the next few months?
Now, it's worth keeping this in perspective because, yes, the dollar has weakened by about 8 to 9% on a trade-weighted basis against most of the other major currencies since the beginning of this year. But from September of 2024 to January of 2025, it went up by about 9 to 10%. What happened is that towards the end of last year, it looked like the US economy was continuing to perform very strongly, while the rest of the world looked like it was in a shambles, except for India, which has continued to grow very well. In the beginning of this year, especially with the imposition of the tariffs, that narrative changed. While the rest of the world was certainly going to take something of a hit, the effect of the tariffs was going to be much greater, relatively speaking, on the US economy. So the relative change in the US growth prospects and the likelihood of a Fed rate cut perhaps increased. So you could explain the dollar's rise and then the decline since the beginning of this year as largely driven by macroeconomic factors. But as your question suggests, there might be something deeper going on, where there is a desire for diversification away from the dollar, which might be adding to this dynamic in the foreign exchange markets. So at this stage, it looks like the dollar has stabilized. And what happens with the trade negotiations, with the tariffs, for which there are many deadlines coming up in the next few weeks to see whether many of these tariffs will stay on or will be rolled back, that's going to be crucial.
Right. Of course, so what happens on the 9th of July would be very important to see if those reciprocal tariffs come into with full effect. I'd like to ask you about the India-US trade negotiations as well. And we have been speaking to experts today after a conclusion of 6 days of negotiations here in New Delhi. The worry is that US is using very coercive tactics to have a deal with India and pressurize India to open up its agricultural sector, bring down non-tariff barriers, have digital trade on US terms, all of this before the 9th of July. If we end up having this interim trade deal and also a full trade deal with the United States, how much of this is going to help the Indian economy, according to you?
Now, I think India is very well positioned in terms of where it is on the geopolitical divide right now, because as you know, US-China tensions seem to be coming off the boil a little bit. But I think given the bipartisan hostility towards China, there is going to be at least a modest decoupling between the two economies in terms of trade and financial flows. And many American manufacturers are looking to relocate their supply chains, and India is very well positioned in order to take advantage of these geopolitical and economic dynamics. So I think a trade deal would certainly be very helpful in that context. The worry I have is about how durable such a trade deal is going to be. We've seen that even long-standing trade deals, for instance, the North American Free Trade Agreement, which became the US-Mexico-Canada Agreement, even the second iteration of that, which Trump himself negotiated, has been opened up for renegotiation once again, with Canada and Mexico initially being hit with tariffs by the US, although that got rolled back. So my worry is that India might give up a lot, but not really get the sort of durable reduction in trade barriers between the two countries that it would hope for. But certainly, anything that can de-escalate the tensions between the two sides and open up trade and, more importantly, financial flows between the two countries is going to be helpful. And the question is whether this deal can be structured in such a way that India does not take a very big hit in terms of some sectors that might not do very well faced with foreign competition, but at the same time, where the US side and particularly Trump can declare a win. So as in many other bilateral negotiations, the question is how best to craft a deal in a way that Trump gets his win without India necessarily giving up too much.
All right, Professor Prasad, thank you so much. It was a pleasure having you on our show, Global Lens, and giving us your perspective on not just the US CPI data, but also the diversification away from the dollar and the India-US trade deal as well. Let's move on now and get you a quick look at the